Now that the Fed has cut interest rates, consumers have a lot of questions. I know I do. How soon will those changes go into effect, and how do we make the move to make our money work for that?
I know who we should ask. Nydia Hahn standing by. She's been talking to experts. She joins us now in the studio with the answers.
Yeah, we were expecting this rate cut, right? But it was the first one in 9 months, and it was 1/4 percentage point. And we do expect 1 or 2 more rate cuts before the end of the year and again in 2026. Now, common perception is rate cuts have an overnight effect across the economy, but the real impact isn't that dramatic. How soon your pocketbook will feel an impact from the rate cut depends on the type of loan or debt you're carrying.
So somebody who might be carrying a balance on a credit card, you might start to see the rate change within 1 to 2 billing cycles.
Home equity lines of credit are also variable and likely to go down within a month or two. But if you're a prospective home buyer or looking to refinance, be aware, rates have already been on a downward trend, and at this point, you have more of an impact on your rate than the Fed.
Your credit score is going to be hugely impactful on what rate you actually get.
And while the rate cut is generally a positive move for borrowers, there is the other side of the coin for savers.
So interest rates on savings accounts are going to go down.
That's a great point, and I think often lost in the discussion is that one person's borrowing is somebody else's saving. The yield for something like a money market mutual fund is going to go down, and already has once the Federal Reserve's near-term plans became clear.
But finance experts say don't panic and don't make any major moves based on the Fed.
Whether you're borrowing, whether you're saving, whether you're investing, your strategy should be the same. Have a long-term view of how you manage your finances. And the best thing you can do is spend less than you make, pay down high interest debt, and invest for the future.
As for auto loans, those are generally fixed and won't change unless you refinance. But refinancing to a lower rate isn't necessarily going to make a big difference in your monthly payment, and usually origination costs don't make refinancing those loans worth it. Back to you guys.
As always, good advice, Nydia. Thanks so much.